JD.com is priced as if it's going out of business. With only a forward P ratio of an 8, they're usually the types of names you don't want to touch. And yet JD could be one of the most exciting tech companies right now, an e-commerce giant operating in domestic China. Should we stay away from the stock equivalent of a Chinese finger trap, or should we buy this company on sale for a great price? Let's dive deep into that question today, as well as the business model of JD.com. Let's begin with the breakdown of JD's business. JD.com is a tech and logistic giant of China, currently worth $52 billion US. JD makes up one of the 3 e-commerce dragons of China, the others being Alibaba in Pinduoduo. All 3 operate an Amazon.com type of business, which include logistics, an online store where they sell their own products as well as third-party business products. However, JD is quite unique out of the 3 dragons. It is the only name that is a pure Chinese play. When you invest in JD.com, you don't have to worry too much about American buyers buying up Chinese exports. However, you still need to be aware that a bunch of JD's business is importing international goods and trying to sell them domestically within China. China's e-commerce competition is one of the fiercest landscapes out there. So it's not just like Amazon and eBay, where Amazon has basically dominated Western countries. JD is only one of about 5 big companies. Now, at the moment, JD.com has a 16.5% market share, which is a good place to be. Not too small, they can get absolutely bullied, but also not too big like Alibaba, where their market share is slowly getting eaten up by competitors. There's a bunch of new kids on the block like Douyin, which is Chinese TikTok. There's a brand new private competitor who's brand new on the market since really 2020. They're called Xiaoxiao. I think I'm saying that right. They're not even included in the market share studies just yet, whereas JD.com and Pinduoduo seem to have maintained their roughly 15-16% market shares respectively, and that goes all the way from 2019 through to the end of 2023. Because of how aggressive the competition is in Chinese e-commerce, we have to be absolutely certain that the company we buy has a very strong moat. It's not just going to be replaced by the next company like TikTok or Douyin. And I make it a personal rule with any company that I put money into that it has to be a company I could be comfortable holding for the next 10 years. Even if it's for a 9-month trade, a 2-year trade, you just never know how long you're going to be stuck in that company. But it's also a nice checkpoint to see you're buying high quality companies. And this is where JD.com shines as an investment, and it also explains why maybe Alibaba has started losing the e-commerce war. The main competitors, Alibaba and Pinduoduo, they run asset-light marketplaces. In other words, they do not host all of their products they sell in their own warehouses. Think of something like an eBay or even a Facebook marketplace. They're a facilitator. They can take a bit of a fee. They have a social side of the marketplace, whereas JD has invested heavy on the front end, much more than the other competitors, and they own 100% of their own logistics networks. It's very hard to try and get rid of JD out of the e-commerce business sphere because you're going to have to use one of their thousands of factories and warehouses. JD.com have their own equivalent of an Amazon warehouse network with over 1,600 locations. Many of them are fully automatic, lots of conveyor belts, robots, drones, picking up and sorting the packages. They have as much technology development as bigger companies, like I said, like an Amazon that operates throughout the rest of the world. And JD.com is very unique in this, that they own everything in the logistics chain from where you click to buy on the app. They own all of that technology, all the back end. Then they have the logistics network sorting through all those packages, the technology with the robots. Then you have the transport network, which is top class in the world, where about 95% of the orders coming through are delivered within 24 hours. And JD.com doesn't just stop there. In terms of its brand of trustworthiness, they are also the place in China where you buy authentic imported goods. Think of Apple iPhones or top quality handbag brands. I can't even remember the ones that my fiance keeps telling me, but you can buy all of those on JD.com, and that's kind of the place to go, because of the overwhelming amount of knockoffs available in China. Now we can start looking at the income statement of JD.com and see what's going on in terms of profitability and cash flow. This income statement is quite healthy. We have 15.7% revenue growth over the past year, so that's Q1 2024 to Q1 2025. The total costs are also up 15%, but the good news is the operating margins of JD.com are so narrow right now, just 3% last year, up to 3.5% in Q1 2025, that we still have so much room for improvement. Maybe we could get this up as high as 10%, 20% operating margins eventually when the company is very mature, about a decade into the future. And just that slight improvement in operating margin from 3 to 3.5% in a year, that led to the operating profit of the company skyrocketing up 37%. With the beautiful mixture of low profit margins, but also low valuations, that's leaving a lot of room for share buybacks, and that's just really jacking up the EPS growth. Now, share buybacks for the rest of this year are planned to be, I think it's around 4.5 billion. That's the equivalent of 10% of all company shares being bought back in the year 2025. Speaking of which, we can have a look at the valuation story of JD.com right now. So I've been looking at maybe putting in 40-50% EPS growth for this year based on that Q1's performance. That's already been penciled in for 2025. But this is where we hit our first stick in the mud here, our first snag. And they are saying here with analysts that we are expecting 27% decline in EPS for the whole of this year. That already sounds pretty damn terrible, but like I said, we've already penciled in a 60% quarter. That means for the rest of the year, analysts are expecting a 44% decline in earnings per share compared to last year. What's really interesting here though, is that analysts do expect a growth of 12.5% in revenue growth for 2025. That means that the collapse in profit per share must be coming from profit margins, an over 50% cut in 2025 for profit margins. Now, to help fact check this, we're going to have a look to see, okay, what impact can we actually expect from these US-Chinese tariffs? And the best chart that I could find to help support this or help shine some light on it is actually from 2022. Now, this graph is showing us out of all the imports that JD sells on its websites, about half of them come from the United States. With the current situation between China and America, the average tariff across all goods is about 32.6%. Now, this is not the best news for JD.com because they actually sell around 80% of their revenue coming from their own listed products and about 20% coming from fees on third parties. But we can't forget the far majority of JD's business will be selling domestic Chinese products to Chinese people. So to me personally, it's looking like this idea that a 50% hit to profit margins for JD is a bit unfair, maybe because the American imported products, they slap the highest profit margin on those. Maybe that's how you get there. But personally, I'm quite skeptical about this negativity. But I think it's fair to say that nobody really knows what that true number is going to be in the next couple quarters. And I think there's a good chance that JD.com is going to beat those analyst expectations. The last component worth talking about today is addressing the idea of a potential white swan event. Now, that's the opposite to a black swan, where you have an unexpected negative surprise. A white swan is an unexpected positive surprise, and this one could lead to a 30 to 50% increase in JD.com stock at any moment in the next couple years. And this event comes from the direct stimulus from the CCP. When you're living in a semi-communist, whatever you want to call it, regime in China, in the past year, the CCP has come out and stimulated in many different ways. A couple examples include the CCP coming out and forcing insurance money to come in and directly buy a struggling stock market. Now, this was to the tune of only 13 billion US dollar equivalent, but that's just setting a strong precedent for the government coming in, intervening, and trying to force up higher stock prices. That's probably good news if you also own those same companies. And we also have the banking system relaxing their standards, trying to increase the lending power, the amount of loans being conducted. supporting a stronger Chinese economy. For example, we have the lending reserve ratio in China get cut by 10% in the last 7 years. For Chinese banks 7 years ago, for every $100 of customer deposits, they would only be able to conduct loans with $83 out of the 100. Where they currently sit today with that lending ratio, they'll now be able to loan out 93 out of the $100. And this has led to a highly volatile economic situation in China that's really been continuing since about 2022. A lot of people, and myself included, don't trust a lot of numbers that come out from authoritarian dictatorships. However, personally, there are some pieces of data that I think can be double checked and fact checked by other countries, such as the manufacturing data. Many of those manufacturing goods, yes, sold within China, but a lot go to the rest of the world through exports. So it's very hard to lie about this data. So we're going to jump to a manufacturing PMI index, just showing what's going on in China over the last few years. China's manufacturing PMI takes into account employment, pricing, future orders, and sentiment, where a value of 50 is considered neutral. So China's been swinging up and down below this 50 level for the past few years, struggling strongly in a few different places, like in 2022 because of the Rona situation, but also recently with the Trump tariff war being extended. However, in the last month, we've actually come in with a strong number, going above neutral, maybe showing that trade manufacturing is starting to kickstart once people got over the initial US-China trade war fears. So betting on a Chinese company like JD.com, there's a lot of positives in your arena. You have, yes, that potential growth in operating margin, which could increase EPS by 30-50% in a year straight away. But you also have the Chinese government, which could roll out the red carpet, stimulate the economy, and straight away investors jump on board, sending stocks up 30-50%. So looking at the final price chart for JD.com, if we assume that in the next 12 to 18 months, we get maybe a 25%, 30% earnings per share growth number, even if we have some weakness, in the next few quarters, we'll get back to strong growth soon after. And I think it's fair to see a PE ratio expansion. We're only sitting at a 8, which is absolutely crazy behavior there. That could at least go to a 12, maybe a 10, but 12 is a good target for us to hit on the upside in the next couple years. So if we put that together, a really good target for the next 12 months, we'll be hitting those highs of $46 a share, which would actually be a 46% increase in stock price. But for the next year after that, so about within 2 years, it would be good to see JD hit a target of a mid-60s level. Again, this is a decent move higher, 100% gain from today's levels. But if you plus on a couple good quarters of profit growth performance, and then again, a strong stimulus package coming from the CCP, that boosts the sentiment around Chinese companies. That adds 30-50% straight away. That's happened a few times in the last year. We can see it spike up above these levels, and I'm kind of treating JD.com as a trade in my own portfolios. I've also just added it to my growth on sale portfolio. I'm treating this as a trade, maybe seeing a 50 to 100% gain. If there's some good American stocks on sale at the same time, I'll probably take the profit off the table and put that into an American company. But I'm thinking this is setting up as a great place to initiate a trade, in my opinion. Let me know if you like the video, guys. If you like the content, make sure you subscribe. See you guys next time. Bye.